Ladies and gentlemen of the crypto space, we're live late on a Friday, September 29th at 4:43 p.m. We're watching the clock. The government's gonna shut down. Nobody saw this coming. Markets are forward looking, so obviously, if it has not been dramatic, we assume it's been priced in to a degree, and obviously that's separate and apart from plumbing breaking. All of a sudden, something systemic with regard to liquidity, causing some sort of unexpected insolvency or some sort of financial event that is unaccounted for, and that's where you get the dramatic activity. So right about now, everything is par for the course, and what I have eyes on is directionality and we consider directionality reversals depending on data that we have access to. And we're limited to a degree, but it looks like if anything systemic is going to occur, it's going to come from Japan or China, China's housing market and Japan's bond and currency market. So we'll go over to the data and see if there's anything interesting that we could pick up on a Friday afternoon as the United States government is prepared to shut down because of geriatrics. They can't keep it open. There's not enough Ovaltine or some sort of denture bonding paste available for them in the Capitol buildings. So the dollar is what crushes everything, and the dollar is basically driving the bond market. As Luke Roman so nicely says, the beating will continue until the dollar comes down. Why? Because foreign countries, foreign sovereigns have to sell their savings, and they saved historically maybe, in U.S. debt denomination. So when they have to defend their respective currency market, or they have to buy energy, which is at 90. So if energy came down, that means their dollar needs are a little bit less. It relieves a bit of pressure for them to sell their savings account into dollars to buy that dollar denominated energy. So the pressure's off a little bit. A little bit. Dollar topped at 106.828 on a daily. Bearish engulfing, but we've seen a bunch of bearish engulfings. A little bit of weakness over here, but this was a bearish engulfing after, what looks like a a dragonfly doji of sorts. So there's no reason to necessarily think that this is reversal from a daily perspective. You're still significantly, meaningfully above the daily time-weighted average price. There's resistance, as I've seen on Twitter, looking at volume, the VWAP. But from a weekly chart, that's a decent shooting star. It's not as big as what we experienced at September 22. It's not as big as what we experienced March of 23. But there's 2 days left from a weekly chart perspective. So let's see what happens over the weekend. This would be an interesting candle to see rather large. This one was inconclusive. It was a hanging man candle and then a nice wick to the upside, showing resistance at the 50 SMA on the weekly. We already breached the 50 SMA, so what we're looking for is a reversal here, and then to see how our interaction with the 50 SMA goes, whether there's any expression of support at all, and ultimately falling through the 50 SMA will be comforting from a DXY perspective. But it would have been nice to see resistance. It was only the second interaction with the 50 SMA since the fall below it in Q4 2022, December of 2022, to be more specific. So there's plenty of interaction to occur on the downside in the coming weeks. It could be heading into December of 23 before we get to interaction with the 50 SMA, maybe about 103-ish area, mid 103s. Likely to be the case. We'll probably have to encounter the weekly TWAP first. This will continue to come down or level off, and the TWAP will eventually catch up. We may have an interesting interaction between the 50 SMA and the TWAP. 100 SMA is far below. This is a hell of a overextension above moving averages. The 50 didn't even have time to reverse up. That's how much breadth there was to the upside. Let's go out to the monthly. I was hoping to see DXY close below the monthly TWAP, which would have been that 105, 130, give or take. Um, there is a little bit of time left. I'm sorry, it's not 2 days, it's 2 hours. So the odds are it's not going to happen. We'd have to go literally an entire 100 points to the downside. 105, 130, we're at 106, 160. It means probabilistically that is quite unlikely to occur. So it looks like we're going to be in that shorter time horizon to see how it rolls over and see what kind of resistance or support rather is provided to the upside when we come back down to that 103 area to see what kind of interactions we have. It would be awkward to see a continuation to the upside. There's literally nothing above but sky. You're talking about price levels of interaction. There's no averages, so there's nothing other to indicate other people in the market from a trading perspective are going to provide necessary resistance above head. Literally, the only thing that's moving the market, I'd say, right about now is oil and bond depreciation. So as the collateral depreciates, they're able to buy less dollars, therefore buy less oil, and oil has appreciated significantly. Therefore, the depreciated bonds are giving significantly depreciated or significantly decreased purchasing power in oil denomination, like oil denominated in 10-year bonds. Looks like crap considering the depreciation of bonds of late. But look, you can see like TLT, a little bit of support. So that's why the market is relatively stable today, because there's been buying pressure. Collateral has appreciated a little bit today. Look at this. This is a crash, but you can't call it anything other than a crash. So we're at the point where bonds, I expect to continue to behave in a correlated fashion with risk assets, which is historically not the case. Some prominent persons in economics are looking for the return of the inverse proportionality, where risk on risk assets, U.S. equities, basically risk off into the bond market, and we haven't seen that for how long? It's been years at this point. It's just what it is. And frankly, I'm not too concerned. It's not much of a thought in my mind of equities selling off into bonds, because that is what the world holds. That's their investment. This is not a crypto story. When the world needs money, the world has trillions of dollars invested in equities. So we're going through the psychological thought processes of what actors around the world would do. And if you're going to buy bonds, if the sovereigns around the world are going to buy bonds, they're going to sell their damn equities. There's no capital in crypto markets. It's microscopic in comparison. It's relatively zero compared to the size of the rest of the world. So that's not something on my mind. I am interested, though, in equities selling off, propping up bond prices, and bonds are the world's collateral. So that is the first step in the liquidity cycle that everyone in the very liquidity sensitive markets, specifically the crypto markets, want to see. As the bond prices rally, the global AVE health factor goes up, and that allows the global liquidity cycle to bottom. As Mike Howell shows in his data, it already bottomed last year, but as collateral rallies, that's what allows the liquidity cycle to really pick up directionality steam to the upside. As liquidity floods the global system, that changes the behavior, that changes buy side versus sell side, and this cycle is inevitable. Everything operates in cycles, especially this cycle. So there will be a bottom, at least with regard to starting to see upward pressure. So clearly there's been a bottom if you look at Bitcoin, and the bottom is there back in end of last year. And that's some of the data that Mike Howell shows very nicely with regard to global liquidity. You can somewhat see this bottom as well in central bank G7 central bank liquidity, but it's even more obvious from a global systemic liquidity perspective. If you're looking at like Fed balance sheet, not just, when I said global, you're talking about like M2, but central bank liquidity would be Fed balance sheets, central bank balance sheets around the world, and reverse repo drains systemic liquidity. So there's a whole lot of moving parts, and literally the government's about to shut down. So definitely a whole lot of shit that could go down. Um, but that's why we're looking for key indicators suggesting global liquidity can improve. And the first thing for that to occur is the bond market to significantly appreciate. Yields come down significantly, and that's the inversion of the curve. And then we can have a credit event, and we have a bunch, which basically means various enterprise cannot roll over their debt, but you already have the damn bankruptcy spiking higher than 2008. So it's just fascinating because we see conditions that are akin to '08 already. The only thing we don't see is the damn high unemployment, and these are the conditions which lead me to think we see that softish condition that the Fed has never achieved in their entire existence, the soft landing, where they've padded the system with so many four-letter acronyms like the BTFP that prevented the banks from cascading into one another, that it doesn't fall apart. So my mindset right about now is at, all right, it falls apart or it doesn't. In any case, the bond market rallies at some point, and there goes your liquidity cycle sometime in Q1, Q2. Maybe we have to wait to Q3 2024, but at some point it rallies. It has to be cyclical. Otherwise, the whole system comes to an end. And in that case, we really need MREs and stockpile of ammunition, because then it just gets post-apocalyptic. So I don't necessarily see that scenario being reasonable. It's not impossible, but it's not reasonable, and there's not much you can do to prepare for it. So you might as well still have these financial considerations on your mind, like what to own and how to structure things, and preparing and planning for fiscal 24, because it's coming. It's going to come whether you want it to come or not. So you might as well continue to do exactly what you're doing. So I guess the entire point of today's stream is just finding your comfort zone. It's a theme that I've been talking about for a long time. And as long as you're comfortable letting time pass, it's going to do the work very nicely. So the key indicator to look for when everyone in crypto Twitter and all the novices and the folks that don't really have any experience with these markets, you're looking for the bond market to rally. And that sets up the liquidity cycle. Maybe a quarter, maybe 2 quarters after, but 3 months after bonds rally, come on, the global liquidity is going to be, the global health factor is going to go through the roof. So it's just time at this point, and patience. And have we not exercised patience already? We're almost in December of 23. We've been sitting patiently through U.S. domestic liquidity conditions contracting at their fastest pace in history through 22, to the point where we have negative M2 year over year. I mean, that has never really occurred before to the extent that it has occurred. I mean, you're literally looking back to the late 30s and 40s. Good afternoon, Paul. Pleasure. MFN Coom. Hello. Nice to see you at this late time. Yeah, I had a lot of code to do today. Built a nice animated user interface for my company, and sometimes I get to do fun code. Diego, what do you think about the real world asset trend? I saw that Maker is gaining a lot of attention. Yeah, it's a nice trend. So Maker, has been captured by the institution, the system. I don't see it as it reminds me of like Link, and it reminds me of like Uniswap, it reminds me of 1inch. It's been captured by vested interest that's more powerful than any of us. I see it as being systemically important. It has all the overtones. Like Link screams to me like, yeah, it's going to change everything. Okay, Maker too. It's entrenched. It's infrastructure. I don't see any opportunity. Maybe from a capital gain standpoint, but if you hold MKR, what the fuck is it doing for you? It has no yield. There'll never be any yield, and I don't see it as an investment opportunity. And it's clearly the same thing with Link, but that may be proven wrong. I may have it may warrant a position for the speculative potential for significant yield in the future. That's clearly the narrative that every one of the Lake Marines subscribes to. That yeah, I'm holding it now, and it's going to change the world. It's going to go 1,000 times in the money, and you're going to get 5%, 10% returns in a staking position. I don't think they think that far ahead, and I'm just not optimistic on it remaining neutral. I see it as being already captured by large vested interest. The foundation just sells, and that's how they capitalize. And if it wasn't controlled by those large vested interests that you can imagine, they would be doing more interesting things like collateralize it and borrow against it. It seems like they just have a traditional enterprise operation, human resources, lawyers, and all that shit, and they have to fund them by just selling their asset and not going through all the complexity of what it would look like on the books to collateralize it and borrow against it. So they have a sophisticated operation, and to me, that doesn't scream opportunity. What I want to see is something that is ground up. It is grassroots. It is, the immutable contracts notion where there is no employment, there is no humans, there is no capex to finance research or OPEX to finance employees. I don't want any of that. And that's why they sell their assets. That's why they do what they do. Because they have financing requirements. And I don't want exposure to that. That's why I'm in crypto markets. What I want to own is a set of contracts that have none of that. And that doesn't meet my attributes, what I'm looking for. So I hope that helps. So Maker and Link don't fall into those categories, yet they're obviously going to change things significantly. And I don't find much controversy with any of them. I think their products and services are quite meaningful, and they fit into everything I'm looking for from a financial structure perspective. I just don't see the financial opportunity through my lens. And, many folks would be critical of that statement, but it is what it is. Raul, a pleasure. Sir Joe, a pleasure. Drew, hey Cap, massive fan. You have thought me so much. I've made you think so much. If you lock your curve on convex, then you get CVXCRV and not VCRV, meaning you don't get any weekly voting APR. Is CVXCRV still worth it? This is a conversation that everyone has thought of, whether they're interested in the more mainstream enterprise products, Maker, Link, Uniswap, so on and so forth, or the more contract grassroots type of thing. Everyone thinks of this stuff. What kind of curve position do you want? What kind of exposure do you want to the Federation? I don't have answers to that. In my mind, someone asked on Discord earlier, and I gave about this topic, and I gave the statement, think in terms of, do you need a liquid position, or do you want to make a purchase of cash flow? And this also comes down to where you really see the future of these systems. And to me, the immutable contracts are everything. It's everything. That means they're going to exist in 4, 5, 6, 7, 8, 9, 10 years. So you're going to see the next liquidity cycle. And for me, that's the attribute that I'm looking for. I'm looking for, does it pay now? X, Y, Z. How much does it cost? Y, how much does it pay? When? Now. And Z is how likely it is to continue to exist in the future. And if it pays now and it's immutable, it's going to deterministically pay you in the future because it's immutable. It has to continue doing exactly what it's doing now in the future. And that is what means everything to me with regard to what I see as the best opportunity in these markets. Now, there's a lot of opportunities, but you have to pick what you think is the best opportunity. Because there's endless opportunities. There's opportunities in the equities markets too, from a technology perspective, and probably even from an energy perspective, energy transformation. There's a whole lot of infrastructure that's going to need to be built in this country to handle the critical materials, the stuff on the what this is the State Department or whoever publishes that critical materials list from the federal government. It's going to be a lot of buy pressure and a lot of mining over the next decade to catch up to what they have to cut off from the contracting global supply chain. So there's a lot of opportunities everywhere, but I see my chosen portfolio structure as the best expression of where I see the opportunity. Folks will be so critical of how I've structured the portfolio with regard to my exposure to the Curve ecosystem. I have my diversifications. I have plenty of diversifications. I have exposure to the RWA, real world asset narrative vis-a-vis Frax. I chose Frax over Maker, so on and so forth. And I don't even need to be critical of like a Link or a Uniswap or a 1inch, and everyone will pick their poison. And in the end, no matter the structure of your portfolio, you look back in a couple of years and you assess things from hindsight. And you'll see how well you did, and it doesn't matter how well someone else did, because you can't compare. You make your bed and you sleep in it. You only can play your hand. So that's it. And the most important thing is to be comfortable with the decisions you make. Woosah. And we look at the macro to see where the hell we are and about how long we have to wait. That's the title of the stream. We're watching the clock. How long do we have to wait? You got to wait. It's September. It's October. So you got to wait October, November, December. This is Q4 coming up. You're probably going to have to wait another quarter. You got another 3 to 6 months to see where the hell things are going to head in fiscal 24. And right about now, they got duct tape and rubber cement holding things together. It's going to be interesting. 24 is going to be really interesting. And the one thing I know is I'm very happy with the choices I've made because I am guaranteed to have exposure to see what happens in fiscal 24. Because I choose the base layers. I choose the infrastructure. I choose things that have B2B written all over them, business to business. What protocols are going to be more interesting with regard to the products and services that they offer other protocols? I'm not too interested in the consumer, the end consumer, or products that are focused on the end consumer. And there's countless of those things, like, uh, synthetic exchanges, so on and so forth, perps, so on and so forth. There's a lot of cash flow there, but that's consumer oriented, and I'm much more interested in what infrastructure can cater to those types of businesses. And that, in that regard, my diversified choice is Hero Network. It's the liquidity infrastructure for those types of products and services. So my fancy really is these credit systems, and it just so happens Curve offers such a credit system vis-a-vis CRV-USD. So having exposure to Frax and Curve tickles my fancy with regard to credit systems, liability printing, and in an environment where liquidity starts to flow in and we have a positive sum game reemerge, those are the systems that people are going to look to consume for them to get leveraged exposure to things. And hopefully that helps explain the thought process that goes through my mind when I look at the entire crypto space. I'm talking the entire crypto space. I only see about a dozen or two protocols that are even remotely interesting. from a functionality standpoint, from a utility standpoint? What do they offer? What do they offer the real world? You know, like, oh, I'm going to borrow on Aave, what, to buy some token of another crypto protocol? Yeah, you know, that's interesting in a positive sum environment because that triggers, you know, like price appreciation, but that's a bubble because ultimately there's a credit event in the crypto markets and someone gets liquidated. That causes cascading forced selling. That's what everyone's waiting for the U.S. equities markets. We saw incredible liquidation events in 2022 from forced selling. So I'm not interested in leverage long and buying like that. I want that cash flow though. So how do you get the cash flow from liquidations? You know, frankly, Liquidity should do pretty well. It's as if it likely as it grows into the coming liquidity cycle. What tickles my fancy at some point is EBTC as it grows in the coming liquidity cycle. The capacity to uncap the 21 million Bitcoin limit from a liabilities perspective, that is a big product because limited supply is a shortcoming from a functional financial system perspective. So if Bitcoin is going to ever be significantly used for international settlement, it is required for there to be a credit system. A credit system where liabilities can be printed, collateralized by whatever, but denominated in Bitcoin. And that allows the system to expand, and that allows for entrepreneurship. That allows for OPEX for corporations. Corporations all are dependent on net 30, net 90, net 120, you know, the terms for buying and selling. So you can't just operate on money unless you're talking about literally the biggest of the big companies. But there's the entire small cap, mid cap corporate infrastructure of the planet operates on credit. They don't have cash hoards like Apple and Microsoft and reserves and savings. They need the credit. I mean, look at small cap, or not even small cap from a U.S. equity standpoint, like startups. They operate on venture capital. It's credit. They're borrowing money of sorts. They owe money to someone. So you need that liability regime. That's one of the biggest themes heading into the next liquidity cycle is the capacity to print liabilities. And we already have entrenched infrastructure, just extensive infrastructure in that regard, dollar denominated. So I think one of the biggest themes in the coming years will be Bitcoin denominated liability printing. It's just something that I have my eye on, and I don't think there's really any financial opportunity in the short term. There's not going to be any token, but it's going to be some serious infrastructure, in my opinion, that doesn't exist. So I'm very excited about what they're building over there, what the Badger team is building. I think it's the potential foundation for something systemically significant. Late stream, Brian, much a pleasure. Yes, indeed. Geld's in the house. I mean, look at this USD JPY. This thing is like literally one intervention territory. And if they intervene, they're going to be selling their U.S. Treasury savings account. There goes the bond market. There's your 6% on the 10-year, 7% on 20s and 30s. I mean, come on. Where's that going to head if Japan has to literally unload there? But it's not sustainable because there's only so much savings. So the beating will continue until the dollar and oil significantly depreciate. At some point, there has to be some sort of cyclicality with the dollar. Frankly, it's off its high in September of 2022. It broke through here, so it could be a fake out breakout pattern. This is a monthly chart, so yeah, check back in December, January. So you need a quarter or two, 3 to 6 months to really see where this thing is going to end up heading. Frankly, it bounced off the bottom from a Stochh RSI perspective. Maybe it bumps up a little bit and you hover around here and you see weakness and you see it fall back down and hold the TWAP as support, but then you have lower highs and it finally falls down. You finally get a lower low in January or February and then bumps up against the 50 SMA on the monthly. We still have no interaction with the 50 SMA here. So technically, what we had is a failed breakdown against the 50 SMA back in like 21, give or take. And then we had the breakout, and we have interaction up here. So we've never really had a confirmed breakdown of the 50 SMA since the last confirmed breakdown of the 50 SMA was back in '05. So you had a breakdown, but you had the retest, and it was just weakness all over the place back in '05, and that's it. Everything past 2008 is just bullish dollar. It's been a dollar bull market since 2008. This is confirmed bearishness where you have a breakdown and a retest. And the retest didn't even hit the damn 50 SMA. So either the system is due for some serious cyclicality, as I've drawn on this damn monthly chart, and it looks even better from a yearly chart, or there's nothing sustainable about the directionality, the prevailing directionality. Prevailing directionality meaning it's like Brent Johnson endgame territory. If the U.S. does not intervene in global FX, like the Plaza Accords in '85, back here, that's where we're heading. And that is basically the end of foreign fiat. The dollar doesn't end in the dollar depreciating. The dollar ends where all foreign fiat is used to purchase dollars, and you're up here at 200 on the DXY. And everyone around the world is basically forced to acquire dollars, and who knows what the hell the U.S. Treasury and Fed do at that point. The dollar shortage would be extraordinary. There'd be absolute chaos everywhere. Civil order would break down. Be a catastrophe. So that's why fiscal 24 is going to be interesting to see how long it takes for how much financial failure outside the U.S. needs to occur before the U.S. is either is forced to intervene in FX by depreciating the dollar structurally. The dollar is a relative game, so when you see the dollar appreciating, the dollar depreciating, obviously that has effects on international consumer price inflation, and it has knock-on effects to U.S. domestic consumer price inflation. But directly in this chart, you're not talking about dollar up, dollar down, the prices of shit up and down. The prices of stuff has to do with supply chain. So obviously the dollar appreciating and depreciating has knock-on effects on the supply chain. So it comes circling back around on pressures, consumer price pressures. So this chart isn't what people think it is. The dollar losing its value, 99.5% of its value, isn't the entire picture. It's part of the picture, but it tends to be a lot of hyperbole, and that's important to understand. As it's not like, what's an interesting thing? The Bitcoin narrative is so different outside of the U.S. versus inside the U.S. Inside the U.S., you could get dollars. You go to the bank, you could get dollars. You could work, you can make dollars. Outside the U.S., this chart says you can't get dollars necessarily. You might not have access to any dollars, or you could be priced out of dollars. Around the world, it's very common for dollars to be priced at a premium, just because you literally can't get the bills, the paper bills. If you look at M0, how many bills? There's only $5.5 trillion on the planet. And obviously, looks like a giant mountain, but that's another story. But relative to the dollar liabilities out there, what they've done since '08 is try to deleverage the amount of dollars which is used as collateral to back the amount of dollar liabilities that are on the planet. Like $2 quadrillion in dollar liabilities. You don't use dollars as money, you use dollar liabilities as money, especially outside of the U.S. because there just isn't enough dollars. So that's a big Bitcoin narrative outside the U.S. Very different outside the U.S. Because if you can't get dollars, pretty shitty getting anything other than dollars, any of the other currencies. So, Ethereum and Bitcoin are pretty damn interesting. And you could go back and forth between which is more interesting. Plenty of argument to be had there, which is more interesting as cash, Ethereum or Bitcoin, but that is a separate conversation. But inside the U.S. is different because you could get dollars. So please note that distinction in how to receive the Bitcoin narrative, whether you're domestic in the U.S. or international. I myself am more into Ethereum, and time will tell how well that does. But here's your chart. Time will tell. Oh, should have sold your Ethereum for Bitcoin in September 22. Sure, you would have saved the 20 something percent. That's an interesting one. Let's look at that. How much would you have saved if you sold your Ethereum? 30%. That's a lot. That's meaningful. So what does this mean? This is FX. If you're thinking about Bitcoin versus Ethereum, you're thinking about FX. I treat Bitcoin, Ethereum, and dollars as cash. So basically, depending on macroeconomic conditions, you're adjusting your cash position. And it would have been favorable to swap Ethereum into Bitcoin. But guess what? It would have been more favorable. What's the time frame here? October of 22. Okay, it would have been actually much more favorable to swap Ethereum into Bitcoin as compared to Bitcoin into dollars, as compared to Ethereum into dollars, because Bitcoin appreciated quite meaningfully against the dollar um, in that time frame. So, this is just a quick conversation about 100%. So swapping Ethereum into dollars, no, 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 in September of 22. Swapping Ethereum into Bitcoin would have been a big win. Looking at the Ethereum denominated in Bitcoin chart, considering all the charts denominated in Bitcoin and denominated in US dollars. So this is talking about the composition of the cash position. I don't treat Bitcoin or Ethereum as investments. I treat them as cash, albeit pretty volatile cash, especially in favorable market conditions. Look at that TLT. How are the equities markets? So folks are a little premature at least from a technical standpoint, calling for doom and gloom in the equities markets. I mean, you could literally have a significant depreciation in the S&P, and you're literally just going to get to the monthly TWAP. Another 5% could come off the S&P, and you literally just have the monthly TWAP. 11%, and you're at the damn 50 SMA on the monthly. That'll bring us back to 2020. That's a 30% drop in the S&P, and you're just at the 100 SMA. So you got a lot of mean regressions, and then it could easily bounce, and in 10 years, so it could take a long time to get back to previous highs, but I see the trend as meaningfully up depending on how far interventionists go. So if you go out to like the 6 month, you could literally have a 20% depreciation in the US S&P, and you're literally just interacting with the 6 month time-weighted average price. So time is the hardest thing in markets to grasp. It's what makes and breaks the novice capital manager. Time is the destroyer of portfolios, because you could come back in 6 months and easily find a higher high, especially from a Bitcoin perspective. This is the 6 month Bitcoin chart, and it has never breached the TWAP. So what I like to look at is the 3 month. 3 month Bitcoin chart basically indicates, especially looking at the time-weighted average price, that if you buy Bitcoin below the time-weighted average price, 3 months later, your Bitcoin has been higher always, no matter what. In the entire existence of Bitcoin, in 3 months' time, Bitcoin has always been a higher price in 3 months. So this is considering all the insanity that we've gone through from a volatility perspective. So I love looking at time-weighted average prices and not the price action chart. This is a great way to peer through the bullshit. Same for Ethereum. Let's look at the S&P. That's an interesting one. And that's clearly the case from an S&P perspective. After 2012, it was just up only from a 3-month average price perspective. How's that for peering through the bullshit? All right, let's wrap it up. I appreciate all of you. I wish you all a wonderful weekend. I thank you all for joining me to the end. 21 people in the stream, 7 likes. Hit that thumbs up button. Tell everyone to subscribe because we're getting close. Bottom line is we are watching the clock, and this is going to be an interesting weekend of all weekends. We'll see what the hell happens with the shutdown, but we're getting close. And what does that mean? We'll discuss that Monday, what that means, what that may mean. Catch you on the flip side. Link in the description for the most rational community in the entire crypto space. I appreciate each and every one that survives in there together. Peace.